Everyone is talking about AI regulation, holding hearings and publishing principles. But underneath the hype of corporate AI adoption, a massive, unmanaged liability exposure is quietly fracturing the foundation. Most executives assume their standard commercial liability policies will cover the damages if an AI system goes rogue or makes a costly mistake. Their coverage assumptions are based on legacy policies that may no longer say what they think they say. Legal liability is already forming much faster than the standards meant to govern it. When an Air Canada chatbot hallucinated a refund policy, the airline argued the AI was a separate legal entity responsible for its own accuracy. The tribunal disagreed, holding the airline directly liable for the chatbot's misrepresentation. When real financial damage hits, a generalized ethics statement or a basic responsible AI program fails entirely as a defense. An aspirational white paper on a company website does not answer an auditor's questions about failure handling or decision records. Meanwhile, major insurance carriers have already moved. Right now, 7 carriers are filing AI exclusion endorsements, quietly stripping away coverage from commercial liability renewals. These exclusions are sweeping. They capture authorized internal AI deployments, unauthorized shadow AI used by employees, and even the third-party AI sitting inside vendor software that an organization never wrote and never audited. This exposes a structural problem researchers call the economic override. Economic incentives to deploy new technology consistently beat safety considerations unless an immediate financial penalty exists to counter them. Legislation moves slowly. Voluntary commitments lack enforcement teeth. Because the law is slow and ethics are voluntary, the insurance renewal contract operates as the most potent, immediate enforcement mechanism for AI risk. Carriers don't need to pass a law, they just need to approve a form, imposing direct financial consequences on organizations that aren't prepared. This 5-tier insurance maturity model shows how the market sorts organizations. Tiers 1 and 2 lack controls, risking complete exclusion. Tier 3 is deceptive. Without human accountability, automated controls fail audits. True insurability requires Tier 4's named human checkpoint and a verifiable decision trail. The distance between technical traceability and named human accountability is where companies discover their coverage problem. They believe their engineering controls make them safe, while the insurance market disagrees. Abstract claims of governance mean nothing if they can't survive hostile underwriting scrutiny. Proving Tier 4 status requires answering a rigorous 6-variable checklist. First, underwriters evaluate deployment mode. Does the AI output publish without a human checkpoint? Then they look at consequence architecture. What is the exact financial cost if that output fails? Carriers also require proof of an error reduction methodology to mitigate hallucinations, drift, and bias. They evaluate verification quality, demanding to see the specific credentials of the human reviewing those outputs. There must be audit trail completeness, a time-stamped document leading directly back to a human desk. And the organization must account for its shadow AI exposure, unauthorized tools operating outside IT visibility. An organization that cannot produce answers to these specific questions walks into a renewal conversation empty-handed. That inability transforms a theoretical governance gap into a highly expensive contractual exclusion. Organizations are told to build strict Tier 4 governance programs to maintain insurability. But here is the uncomfortable reality for every executive and risk manager. The math hasn't arrived yet. This is the actuarial gap. No published study connects AI governance to reduced claim frequency. Carriers are sorting organizations, denying standard coverage, and writing specialty policies based entirely on governance signals they cannot actuarially validate. No one can point to a dataset showing the premium differential is actually earned. The insurance market has moved entirely ahead of the math. Compliance right now isn't being driven by empirical proof of safety. It is being driven by the brute economic pressure of losing coverage. We have seen this exact dynamic play out before, in the early days of cyber insurance. This is standard market behavior when the industry is faced with massive, unpriceable new risks. The historical cycle repeats. Carriers exclude the unknown risk first. They force companies to document their internal controls, watch the claims data accumulate over years, and only price it accurately later once the math catches up. European regulations are rolling out through 2028, and U.S. states are adopting new guidelines. But standard market forces are already rewriting the rules of survival today, operating at the speed of contract renewal. The timeline for mathematical proof remains unwritten, but when the pricing loop finally closes, standing outside it with uninsurable, ungoverned AI will be a devastating economic reality for any business.